This video is an OKX futures trading tutorial. We're going to get right into trading on the system, how to enter orders, and how to use the different margin modes. I'll leave timestamps for everything down below. Let's come to our trading system then, so trade and perpetual swaps. If you don't have an OKX account yet, they may be able to give you a deposit bonus or a sign-up bonus. I'll leave the link below if you don't have an account yet. You can see if that's available for you. It's not available in every country, but you can check the details via that link below. If you have an account though, perpetual swaps is what we want to trade. Futures have an expiry date. Most people in crypto choose perpetual swaps, which is no expiry date. So you just open a position, close a position, and then close out the profit or the loss on perpetual swaps. So if you need a beginner's guide on how to set up on OKX, I'll leave that down below as well. But we can come to the assets that we want to trade right here. So we're choosing perpetuals. As I said, futures have an expiry. So we're going to choose Bitcoin against USDT. That means that we fund our trades with US dollar tether and we come in and out of US dollar tether. So that's the thing we'll be taking profit in, is actually the US dollar tether stablecoin, but we're trading the price of Bitcoin. If you need some assets in your trading account, it's this one right here. And then you can just fund from your funding account into your trading account. And that's where you need it to trade. If you need to get money onto OKX, you don't know how to do that. Like I said, the beginner's guide's down below. And then when we're trading futures, these are all the details of the contract that we're trading. Because we're not trading in the spot market, what we're doing is entering a position and then closing a position later. And if we make a profit or a loss, that comes into our account. If we make a loss, we're funding those losses with US dollar tether. You can see right here the details of the contract. If you are new to OKX, you have to choose the account mode that you want to trade in. So it's this button right here, upgrade to trade. So we'll click this and you can see that margin free we're in right now, which is the default for when you open an account. So you have three different margin modes right here: single currency margin, multi-currency margin, and portfolio margin. As you can see with single currency margin, this is common to use for derivatives like perpetuals and futures, which we're trading. The derivatives hedging with the same settlement currency. So we have essentially a stable coin, right? So if you have US dollar tether or USDC, that is what you're using to margin your trades. When you trade futures, you just put margin on account, and that margin, the value of that, is used to pay for any potential losses. Right? So what we're doing here essentially is using stable coins to trade and margin all of our trades. That's what most people should be using for the most part. Multi-currency is when you can use different currencies to hedge or to trade different assets. So as you can see here, you can arbitrage with the same or different settlement currencies: Bitcoin against US dollar, Bitcoin against USDT. Derivatives trading for currencies that you don't hold, e.g. ETH USDT perpetual swaps when you only have Bitcoin, right? So you can actually fund trades. Let's say you have one Bitcoin, you can put that in your account and you fund trades with Bitcoin, but you might be trading ETH against USDT. Now this is more risky because of course you have a risk asset like Bitcoin funding positions in other coins. So potentially quite more risky because you're opening yourself up to more price fluctuations. Portfolio margin is pretty much a similar thing where you can essentially use, all the assets in your account to margin the trades that you have. So you can actually turn these on and off in your account if you want, but this is for more complex trading and strategies. A lot of more professional investors will have assets that they want to hedge them in different ways and using futures like that. It's definitely more complex. We'll just stick to the most popular right here, which is essentially using stable coins to back our trading. So we'll switch over to that, and then you can use the currencies to actually go ahead and trade with. There is a difference between the mark price and the market price that we trade. Because we're trading a contract with futures, the mark price is the official price of the contract. And this can be a little bit different than the market price that we see right here. When we have trading levels like stop loss or take profit, those trading levels are based on the official mark price of the contract. So if we have a take profit at 35,000, the official mark price of the contract has to get to 35 for our trade to trigger. They are very similar, but not exactly the same. And so we just have to make sure that we know that the mark price is the price that we trade off when we have other trading levels. Funding rates are also something to keep an eye on. When you enter a crypto futures trade, there is something called the funding rate. Now, this is something that occurs because the crypto futures contract is not the spot trading price for actual cryptocurrency. This is simply a contract based on the price of the underlying, which is Bitcoin against US dollar tether, right? Now that contract and the actual price in the market can have a difference, and that's not good. So they need a method in which to keep the contract price and the spot price as close together as possible. And the way they do that is by either incentivizing or punishing the market for taking it one way. And so when you're going long and pushing the futures price up too much, you have to pay basically a fee or an interest rate for going long and pushing the price up too much. So when the futures funding is positive, like you can see here, it means that long positions are paying a fee to go long. Now, if you take a short position, which is, betting on the price going down, then you will actually receive this funding from longs. So if the funding is positive, you're paying it if you're long and you're receiving it if you're short. If the funding is negative, you're paying it if you're short and you're receiving it if you're long. We can trade in either one-way mode or hedge mode. There is a little bit of a difference here. So go to settings and then position mode. One-way mode I'm in right now. One-way mode is you can open a position in an asset, right? So we're going to open a Bitcoin long position for $10,000. Let's say we're in profit. Midway through our trade, we think the Bitcoin price is going to move down a little bit. And so we want to take advantage and actually take a short position over the short term, but we want to keep our long position. With one-way mode, what we would do is reduce the size of our long position. So let's say we have a $10,000 trade and we're in profit. We can essentially close half of that position and essentially sell that position. Now that's not going short, you're just reducing your long, right? Now with hedge mode, you can actually take separate long and short positions at exactly the same time that are separate from each other. So you have your $10,000 long, and that would be in the market and that would be trading. You can also take a completely separate short position where you're trying to take advantage short term of the price dipping. Those positions are completely separate. They're running at the same time. You can manipulate them separately from each other. One-way mode, you can go long, and if you want to sell some or go short, you have to reduce the position. So you can't open long and short together. It's only one position. You can go long, you can go short, and if you go short more than your long, then it just reduces down to zero, and then you have to open another position short, right? So hedge mode might be a little bit easier for you to just do both, but it doesn't matter too much, right? One-way mode maybe reduces risk a little bit if you're taking, crazy long positions and going long and short often. You can choose, I'm just going to stick one-way mode for now, but if you want two positions open at the same time, you can choose hedge mode. We can also trade using isolated margin mode or cross margin mode. Now we've already selected the simple margin mode before that we have, so we should just be using US dollar tether to fund the trades. But up here, you can either isolate each of your trades, which means you have an amount of US dollar tether that you're using to fund that trade, and that goes towards your Bitcoin position and it's cordoned off. You have an ETH trade, you have an amount of tether in there as well. Cross margin just means each and every trade that you open, it's all funded with the amount of dollars or US dollar tether that you have in your account. Isolated reduces risk a little bit. If you have a position that's losing, then you can just cut that trade and cut the losses there, and it doesn't affect the margin that you're using for your other trades if you have them. So cross everything and isolated each a position separately. I'm going to choose isolated margin, and then we'll open individual positions. Before trading, we're going to put some simple technical analysis on the chart just to give us some key price levels. Crypto futures are really for day trading or short-term trading, swing trading. And so we need some key levels to understand, if the price moves against us, where should we place our stop loss? Because the stop loss is the key to this. Once we know where our stop loss is and where we're comfortable taking losses, then we can work out how much we can trade with and if we want to trade with leverage and if that's going to increase our risk, which I'll go through right now. So firstly, let's put some simple TA on the chart. This key level here is an area where the price was in a tight range. This is known as a support and resistance level. We can see that the price also rejects from here and it rejects from here, and then it breaks through at this level. This level is obviously key, and so I'm going to draw that right here like this with a horizontal ray, which is this one. So horizontal ray again. We're going to look above this price, which seems to be around this level. You can see a lot of trade here and here. So probably somewhere around here. And then maybe, you can do below as well, but that's quite far away from the chart. So for me, that is probably a support and resistance level below and a support and resistance level above. Now, obviously it's support below and resistance above. That's as simple as it gets. You can see we're trading right in the middle of that range now. Now, just from these two lines, now it makes it a lot simpler for a day trade. Do we think it's going to go up to resistance, or are we going to get rejected and move down to this line? That makes trading a lot simpler. Now, what we can do is use, charting analytics. We can use some trade patterns as well. I won't go through that in this video. I'll leave some video guides down below for that if you want to know more. If you want to know how to use TradingView as well, which is brilliant trading software, I'll leave that video down below as well. Now, if you are day trading or trading shorter term, what you can now do is determine which side do you want to be on, right? So are you going to go long? So you're entering a position hoping for the price to go up, and then you close the position and you pocket the difference. You can also go short, which is actually selling first, waiting for the price to go down and then buying back lower. And that's actually taking advantage of the price going down. The reason we can go both long and short is because we're just trading a contract here. We are taking positions on the price. So we can benefit when the price goes up, we can benefit when the price goes down. We buy low and sell high on both occasions. You're just buying first here and then selling higher. And here you're trying to sell high first and buy lower. So it's buy low, sell high. Just you can do either one. You can start with buying or you can start with selling. So what we're going to do is go down to the 4-hour chart right here. And now we have, each candlestick is 4 hours. Again, I won't go through some TA here and what are candlesticks. If you don't know that, I'll leave the beginner's guide in the description. So let's say we've had this, big move up. We've had a kind of rejection and consolidation. And then we have basically 4 candles, which seems to be, moving up again. So it seems to be a bullish time. We've moved up a lot, but hey, we think this is going to continue. So what we can do now is work out where we can take our positions and how much risk that we're taking. So the first thing we're going to do is go and do a long position. So I'll just show you a long position as an example. So let's say we want to take a long position at this price. So this is what we do. Now we have this calculator in for us. Where would we want to take profits? Well, we're in no man's land right now. So where are we going to take profits? Well, as we saw, the take profit level may have been up here. That was the next resistance level. So let's say we want to take, profits just under there. And let's say that the stop loss, this is way too much for a stop loss. Let's say that we put the stop loss somewhere near the swing low of the previous candles, which, may be around here for us, right? So now what we have is a potential entry level, a potential stop loss level, and a potential take profit target. The stop loss is the most important thing because we know from the entry to the stop loss how much that loss will be. And so because we know that loss, we can then work out how large our position size can be based on how much risk that we want to take. How we work that out is a trade size calculator. I'll link the one I'll show you here down below in the description. It's just an online calculator. So let's say we have $1,000 and we want to enter that position. We can see that our position is entered at the gray mark, so 34,022. So go to the trade size calculator. We are, investing in Bitcoin US dollar. So the open price we know is 34,022. And we have the stop loss price. This is the most important thing because it shows us how much we're risking in the trade. That is the red one here, 33,171. So now we have an open price and a stop loss price. Let's say we have $1,000 account balance and we want to risk 2%. Most traders will risk 1 to 3%, something like that. If you're really confident in a trade, if you just want to take more risk, maybe 5% of your trading account, you can do whatever you want. We'll do 2%, right? So calculate. Now we know that if we have $1,000 account balance, obviously 2% of that is $20. But the trade size is important. Depending on the asset that you're trading, the amount of units of that you can trade is going to be different because each price is different. But we know that if we have $1,000 now, we can trade 0.02 of a Bitcoin, or let's just round up to 0.03. So when you go back and trade, you now know that you can trade with 0.03 as a balance. So 0.03 is what you can trade with. And the reason we know that is because if the price moves down this much and we actually trigger our stop loss and lose, that percentage difference there is a $20 loss for us based on this position size. Now let's get into using leverage, because a lot of people use leverage when they're trading crypto futures. Now you don't have to use leverage, but it's something that you may want to use for a couple of reasons. The first one is we can change this right here. So you can see I'm using 3x leverage right now. I'm just going to change this to 10 and just press confirm. Now, what leverage does is it just lets you put less down in the trade. So let's say we want to open a $1,000 position and we have no leverage at all. So we're using 1x leverage. On a $1,000 position that we're opening, you can see that here, the position size is $1,000. If we're using no leverage, then we have to fund that trade. And so you can see the cost of the trade, to me, is the exact amount of the trade, $1,021.64, right? Exactly the same. We're not using any leverage. What leverage is when the exchange gives you the ability to trade much larger size than you actually have. Now, what happens is the trade doesn't increase in size. It just changes the amount that it costs you. So I'm going to go 10x leverage here, press confirm. Now the trade size has not changed because I'm trading that $1,000 position and I want to lose $20 with my stop loss. So I know it's 0.03. What has changed is the cost to me. 10x leverage, I now only have to put $100 down into the trade. So you don't have to use leverage to increase the size of your positions, right? What you can do is use leverage to reduce the amount of money that you put down. Now that means that you can keep less crypto on the platform if if you like holding it in your own wallet, or maybe you're trading Ethereum and you have Ethereum in your wallet and you're staking it earning 3%, you don't want to take it out. So what you can do is just put less Ethereum down into the platform, more is being staked, and you have less down, but you're trading with amounts that you're comfortable with. So you don't have to use leverage to increase your position size. You can just use it to put less down in the trade and then maybe have more trades open at once, like that. So it just spreads the cost out. So you can also just use leverage to trade with more money than you have. So you can put, let's say, 0.9 here. Let's say you have $500 on your account. You can trade with, $300 of it, but you're actually trading with a position size of 3,000. That is increasing the size of your trade more than you actually have, right? So let's say it costs us $300. That's all we have in our account, right? $500, but the trade size is 3,000. That increases the size of our trade, but it also increases the risk of our trade because we are risking more as a percentage of what we have, right? So if you are leveraging up to increase the size of your trade, you're taking more risk. You might be fine with that, and that's up to the individual trader, but you don't have to take more risk when using leverage. You can do that, and you don't have to. The number one thing to look for when trading is the liquidation price of your trade. This is the main thing, and it is your risk. So what we're going to do here is put 0.03, which is 2% of our account of 1,000, and 10x leverage here. We know that our cost is $100. What we're going to do here is press the calculator, which is just below my head. You can see it right here. And we're going to do liquidation price. The main thing is we never want to get liquidated when we're trading. That's a big no-no. You pay extra fees when you get liquidated. Now, you're not going to go into bad debts. The system will not let you go into a bad debt. So if you lose all your money, you're going to get liquidated out before you lose anything and have to owe them anything. But of course, getting liquidated isn't great. It's not the end of the world. If you're just someone who says, I'm going to open this trade with this amount of money and I'm happy to completely lose all of it, then you can just open the trade. But that's obviously not good risk management. Professionals aren't going to trade like that. So what we can do is just work out where is our liquidation price. If our liquidation price is in our stop loss, let's say our stop loss is down here and our liquidation price is like up here, we're taking too much leverage, or we're just, trading with the wrong prices, right? So what we're going to do is, leverage. We're 10x leverage. Our entry price is that price that we had, which was 34,022. And the open amount was 0.03 BTC. And we're going to calculate the liquidation price. 30,758. So we know if we open that position based on the amount of collateral I have on the account right here, liquidation price 30,758. We know our stop loss price is 33,000. That's absolutely fine. Our stop loss is 33, our liquidation is 30. Our liquidation is miles away from our stop loss, so we don't have to worry, right? We are well within that. Now what you can do is move your leverage up to like 20x, calculate again. Now the liquidation price has moved up to 32. Why is that? Simply, the more leverage that we're using, the less we're putting down in the trade to fund our losses. And so there's an equilibrium point where you are putting so little down into the trade that the liquidation price moves up above the stop loss. Because you're just, let's say you have a $20 loss and your stop loss, you're using so much leverage, like you're using 30x leverage here. And now, that liquidation is getting close to where our stop loss is because we're putting so little down in the trade to fund the losses. So just work out your liquidation price. Now, for the most part, if you're using 5 to 10x leverage and your stop loss is within a reasonable amount near your trade, you don't have to worry about the leverage, the liquidation. It's going to be a long way away. If you're trading with very high leverage, just watch out for that liquidation. Now we can enter a position and we can place our stop loss and take profit orders when we enter the position. We can also enter that after as well. So limit orders if you're trading, but I'm just going to open a market order just to show you. Amount in BTC. We know that we can just slide this up to how much we can trade. It doesn't really matter too much, right? So what I'm going to do is actually change this to US dollar stable. So this gives you a dollar amount, right? So instead of trading a unit of Bitcoin, we'll just trade like a $50 trade or something like that. So the amount available here and the max that I can trade with. Now we can press take profit stop loss. And these are our target levels, right? So let's say we had our stop loss here at 33,171. So we can put that in. You can see when the mark price reaches 33,171, it will trigger a market order and the estimated P&L will be minus $10, right? So that would be the stop loss on this. So you can enter the take profit target here as well if you want. You don't have to, you can enter that later. So what we'll do is just buy long like this to open up the order. If you don't want to see this again, just press don't show again, but you can see the market price. Price gap, you can see isolated market order, liquidation price is 30 and our stop loss is 33. So we enter that and confirm and that's an open order for us, and then we can go to open positions. So now we have an open position and it says current right here, meaning that it's actually open and in the system. What we see now on screen is all of our order details. You can see this on the chart as well. So up here we have the entry price and the size. We have the entry candle. And then we have our stop loss price because we put that in. You can change this around. So if you drag this around on the chart, it's going to change your stop loss price, brings this up to modify the order. We can see that the stop loss has been modified, and so we're going to confirm that. You can also go down here to open orders and then look at this. So TPSL, this is an open order in the market because it's an open trigger order to sell at this price. Hopefully it doesn't get there for us. We can also come down here and press modify, and that brings up this same box. You can also take the take profit here as well. If you want to enter that now, you can do. So you can enter that on the screen at the price that you want and modify all of the order details right there. If we go to our open positions, this is just the details of the order, the size, the entry price, the margin that we're using, estimated liquidation here. That is going to change depending on how much margin that you're putting in the position. As you can see here, margin. So you know we're margining the position with this much money. You press this, you can add or reduce the amount of collateral that you're using to fund this trade. So let's say that the price is getting down to our stop loss and we actually want to put more money in the trade to make sure that we don't get liquidated. Just add some margin to the trade. That means that the liquidation moves down because eventually you could actually just put enough dollars into margin the whole entire thing and not use any more leverage, right? So the more margin you put in, the less leverage that you're taking with the open position, because the open position doesn't change. What changes is how much money you're putting in to margin that position. So more money in, your margin or leverage goes down, right? So you can change that either to add or reduce. So we'll cancel out of there. Now what we can do is go to our open position and go down to our floating P&L. So this is the P&L of the position in the market. And then the break-even price, 34,161. So we are in a little bit of profit here. Now this level here, you can do two things. You can close a little bit, or you can close the whole entire order. So let's say I click this and I want to close 20% of the order. What that does is close out some profits and reduces the size of the order. So if we're at 100% order size now, we're closing out, so now we'll be 80% order size. That reduces the size of the trade and reduces the margin that you've got tied up as well. So it reduces the size, right? So you can close that. If you want to take some profits, let's say you're in 50% profit, you can basically close the out the order to take some profits out, reduce the size of the trade, reduce risk. From here though, we're just going to click close all like this. That says close all. Do you want to do this? Yes, fine. That's like a market order to close out the trade. And that will close out, wherever this is. So with one-way mode, you can open, you can reduce, and you can close. With hedge mode, you can open a long, you can change that, and you can open an opposing short at the same time. If you are new to OKX, you can click the link below for a potential bonus when signing up. You'll have to check the details via that link if it's available for you. I'm James, it's MoneyZG. Cheers for watching, and I'll see you in the next one.